Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing PG&E stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. PG&E is an investor-owned utility. It has 4.5 million gas customers and 5.5 million electric customers, all located in Northern and Central California. It was established in 1905 from the merger and consolidation of various utility companies. And by 1984, it was the largest electric utility business in the US. In 2018 and 19, the company received widespread media attention when it was blamed for two separate devastating wildfires in California. This led to big losses in federal bankruptcy court. In January of 2019, it filed Chapter 22 bankruptcy in response to its liability for the egregious 2017 and 2018 wildfires in Northern California. The company exited bankruptcy in June of 2020. Before I said they filed Chapter 22 bankruptcy, there's no such thing as Chapter 22. They filed Chapter 11 bankruptcy in 2019. They previously filed Chapter 11 bankruptcy in 2001. When a company files their second Chapter 11 bankruptcy, some people jokingly call it Chapter 22. Chapter 22 does not exist. There's Chapter 7, Chapter 11, Chapter 12, Chapter 13, and Chapter 15. Radioshack is another example of a company that filed Chapter 22, meaning they did Chapter 11 twice. To try to avoid wildfires, the company has implemented several controls, such as system hardening. Over 71 miles, they installed stronger poles and covered lines. Enhanced vegetation management. Over 598 miles, they cut down trees that are close to their power lines. They installed 165 weather stations and 70 HD cameras. They also inspected 355,000 poles. The company established a $21 billion wildfire fund to pay its legal claims to the victims of the fires. These fires were about 30 to 40 miles away from my house. I remember each morning waking up and going to my car, and there would be black ashes all over it. The air smelled like burnt smoke for several weeks. So these fires have put a black cloud over this company and a black cloud over my house. The company's headquartered in San Francisco, California, was founded in 1905. It started trading in 92 and can be found on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Xetra, and Euro TLX. Let's get started with the model. This is a large cap company, 21 billion market cap. They're trading at $9 a share, and they have 2.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have pretty big negatives in free cash flow due to all the claims from the wildfires. Net income is the profit or loss on the income statement. It's revenue minus expenses. And you can see the light at the end of the tunnel for this, because they did have big negatives, but they finally squeaked out a small positive in the trailing 12 months. Revenue is a sales for the company. 16.8 billion is a pretty big revenue number, and they still can grow their revenue every single year. It's up to 19.6 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue in 2019 and 2020. About 60% of their revenue comes from gas and 40% from electric. A bulk of their revenue from electric comes from residential and commercial, and a little bit from industrial and agricultural. Most of their revenue from gas comes from residential, a little bit from commercial, and transportation services is about 1.2 billion of gas revenue. Below revenue is the cost of revenue. These are the expenses that are directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months at $6 billion. Below that is operating expenses. Then below that is operating income, which also peaked in the trailing 12 months at $2.5 billion. So you can see the company does generate a lot of operating income. $2.5 billion is a ton of money. They do have a lot of debt, so they pay $1.6 billion of interest on their debt. And the bottom line of the income statement is their net income. And they finally had a positive in the trailing 12 months. But they had really big negatives in 2018 and 2019. That's due to negative $11 billion from other income and expenses. This chart on the bottom is from their 10K. You can see the big negatives in other income and expenses were the claims the company had to pay on top of their insurance company's claims. Of course, that's all directly related to the wildfires. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they did generate a lot of operating cash flow in 2018 and 19, but a big negative in 2020 and the trailing 12 months. In 2018 and 2019, they were ordered by a court to pay those large claims, but they didn't actually pay anything until 2020. That's why operating cash flow is positive in 2018 and 19 and a huge negative in 2020. You could see from the company's 10K, they had negative $16.5 billion in cash flow from operations related to those claims. In 2018, they added back the $13.7 billion from the claims and $12.2 billion, which were more liabilities from the wildfires. The reason they added the dollar amounts back on the CFO section, because those dollar amounts were subtracted out on the income statement. And remember, the CFO section starts with net income, and then you have to add or subtract the non-cash items. It was a non-cash item in 2018 or 19 because no cash left the company. In 2020, however, that's when the cash left the company. That's why they have this big negative $16.5 billion. And this type of company has to spend a lot of money in capital expenditures, $6 to $8 billion a year in CapEx, because they're constantly building infrastructure, maintaining their power lines, grids, and building new ones as well. Operating cash flow minus CapEx gives you your free cash flow, and that is negative every year, a huge negative in 2020 and the trailing 12 months. But going forward, their statement of cash flows should look a lot better, because it looks like they're getting through all this mess. There may be some residual claims coming up, but the bulk of them happened already. You can see in 2020, they added $13 billion of stock. That money was put into a fund to pay victims from the wildfires. When we look at the top shareholders for the company later, you'll see what I mean. They also added a lot of debt in 2020, $19 billion. They paid down $6 billion, so they added $13 billion of debt in 2020. Let's look at the capital structure. They're $21 billion of equity, $44 billion of debt. They're 1/3 equity, 2/3 debt. So they do have a ton of debt on their balance sheet. But the company does bring in a lot of cash flow. It should be able to pay down this debt over the next decade. Although if they reinstate their dividend, they may have a harder time paying down debt. And their weighted average cost of capital is 6.65%. Regulated utility companies generally have a low WACC. They tend to be low-risk investments because they receive guaranteed revenue. It's pretty much a monopoly, but it's legal because the government controls it. So that's why they have a low WACC. It's low risk, unless, of course, you're responsible for catastrophic wildfires and you're forced into bankruptcy. But outside of that, it's pretty low risk. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7. That's $123 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $56 billion. We divide that by 2.3 billion shares. And we get a calculated stock price of $25. They're trading at $9.26, so they're trading at a 63% discount. It's a really strong buy according to the model. So I estimated they would have negative free cash flows for the next 6 years, and then they would have positive $5 billion by 2027. I think this is a pretty conservative estimate because they do bring in a ton of cash, and I think there's a good chance they'll have positive free cash flow well before 2027. But even if they have it by 2027, I'm still coming out with a stock price a lot higher than they're trading at. So this stock is severely undervalued. Just people don't feel comfortable buying it. Of course, there's a risk they can start more fires, or even if they don't start any fires, some people don't want to invest in a company that has killed so many people and ruined so many people's lives. Simply Wall Street is a lot higher than me. They're at $70 a share. They're saying it's 87% undervalued. 6 analysts priced this stock and the average price target was $14.40. So you can see the stock didn't move too much from 84 to the early 2000s, but you were receiving that 5 or 6% dividend every single year. So if you did put it back into the stock, you could have made a lot of money because 5 or 6% compounded annually does grow quite a bit. But they did file bankruptcy in 2001 and the stock got to a low point, and then it got really high, about $70 a share. So the stock was doing really, really well until the fires came, and then it just crashed. You can see it's trading at a major discount than it was just a couple years ago. A few months ago, the stock was up to $13, And then there was a big sell-off. That's the hard thing with this stock. Even though it's undervalued, if nobody buys it, it's not going to go up in price. It's just going to take time for people to forget about what happened and start buying the stock again. The last time they paid a dividend was in 2017, so I'm not sure if they're going to pay a dividend for a few years. Even though they probably could afford a dividend next year or the year after, they may need to keep cash to pay down debt or to pay more liabilities to the victims. Their beta is a little over 1, so the stock isn't too volatile. It's gone up only 4% in the past 52 weeks, while the S&P 500 went up 29%. The 52-week low was $8, the high was $13, and the stock is trading below its 50-day and 200-day moving average. And this is a pretty liquid stock. 14 to 16 million shares are traded each day. Of the 2.25 billion shares outstanding, 1.5 billion are on float, 75% are held by institutions, and 5.5% of the shares are shorted. So you can see in the past 3 years and 5 years, this stock is down a ton. Analysts are forecasting their earnings to grow 38%, their revenue to grow only 3%. But in dollar terms, a 3% revenue growth is a lot more than 4% for its industry. In the past 5 years, their annual earnings are down 42%, mainly from all those claims. If you invested $10,000 into this company 10 years ago, you would have been at over $20,000 after about 7 years. But if you're still holding on, you'll be at $2,800 today. That's a 72% loss. The company's biggest shareholder is the Fire Victim Trust. They own 24% of the stock, valued at $4.4 billion. So the company issued new stock and put it into this trust to pay the victims. This is good for the company because it doesn't cost them any money. They just dilute the current shareholders. The next biggest is Fidelity, then Vanguard, BlackRock, and Capital Research. Let's look at their financial ratios. Their PE isn't so great. That's mainly because their net income is pretty low. But next year, I bet you their PE is going to be really good, like 10 or 15. They have an amazing price to sales at 1.1 and a really good price to book at 1.0. So this indicates the company's more valuable if they liquidated their business than an active business. If they sold all their assets and used part of that money to pay off all their liabilities, then they would have enough left over to give each shareholder $9.58, which is more than the stock is trading at now. That just shows you how undervalued this company is. They have a pretty low return on invested capital of 3%. They can only cover their interest payments 1.5 times. They have a low ROE at 4%, and they have a pretty low current ratio and quick ratio, but they actually have the highest current ratio in their industry. This industry tends to keep little cash on their balance sheet. They have $10.3 billion of current assets, only $300 million of cash, $7.1 billion of receivables. This is their accounts receivables from their 10K. They report $1.9 billion of back due invoices. This is from their PG&E customers. But as of June 30th, 2021, they actually have $2.2 billion of past due invoices. Because you can see here, they have $304 million in allowance for doubtful accounts. Because it's unlikely they're going to receive 100% of their past due invoices. So they expect to receive $1.9 billion of the $2.2 billion. So you want to accurately reflect the assets on your balance sheet. You don't want to overstate your assets. So most assets you need to reduce, except for cash. That's the only asset you don't have to reduce. But pretty much every other asset you need to reduce or impair, because it could be deceiving if you're overstating your assets. So you can see the company is really undercapitalized. They had negative $29 billion of free cash flow in the trailing 12 months and negative $5.2 billion of working capital. But in the next 12 months, their free cash flow won't be nearly this bad, because it seems like all the mess from the fires is behind them, at least financially behind them. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 5 other companies in the same industry as PG&E. And if PG&E has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So of course they're better in all the price multiples because their stock prices come down so much. You can see their price to sales ratio is the best by far at 1.1. So they have $20 billion of revenue and $21 billion market cap. Look at Next Era. They have less revenue and they're worth 8 times as much, $157 billion. Duke Energy only has $5 billion more revenue and their market cap is 3 times as much. That just shows you how undervalued and what a negative perception these fires have caused this company. They do have the highest current ratio even though it's below 1. They have a low ROE because they just started bringing in net income. They have the highest amount of debt, and they're the only company that doesn't pay a dividend. The reason people invest in utility companies is for the dividend, and they don't pay a dividend. But I think there's a lot of benefit because this stock price should go up a lot. I just don't know when, but it's got to go up at some point. So to summarize, I have them trading at a 63% discount, and you could definitely make 5 or 10x your money on this stock. It could take a decade though, that's the problem. And who's willing to sit on a stock for so many years? That's the hardest part, is the waiting game, because you never know if it's going to really go up. Even if you have really strong conviction, you can never be 100%. So I'm really curious how this company does, and I may pick up some stock because it's so cheap right now. I rank their free cash flows 1 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.